All right, guys, well, I wanted to welcome you to our first in our spring-summer education series, consumer education series from EXIT Strategy Realty. We are doing these the fourth Wednesday of every month. And what we want to do is kind of create more of a bond between us and the consumer. Because what we're finding is a lot of real estate agents are out there just talking buy with me, sell with me, buy with me, sell with me. They're asking for your business and they're giving you no value. They're not giving you the education you need. They're not giving you the level of service you need. And a lot of us, when we started out saying, oh, I want to sell real estate or I want to buy real estate, as a consumer, we didn't pop out of the egg, so to speak, with 800 credit. I started out in my world with pretty decent credit. When the real estate market crashed, my credit crashed right along with it. And I had to build it back up slowly over time. And when I started to do that, I realized a lot of my friends were in the same boat, even sometimes a worse boat. And to sit there and go out and ask for your business without helping you be ready for the business, that's not a service to anybody at all. So what EXIT's going to be doing all spring and summer are these education series. This is the first of 4 for the spring and summer. They're going to be the fourth Wednesday of every month from 6 to 8 p.m. We're going to alternate between this and our North Side office. This is our first one. This is our kickoff, and I think this is the most serious one because a lot of people out there are struggling with their credit. They have all kinds of hopes and dreams, but as Marla's going to tell you in just a little bit, if they don't have the right credit, they can't get there. So we're going to try to help you get there today. This would not be possible today, and the level of energy and service would not be possible today without Zeke Morris, who is our landlord here. He's the founder of EMA Realty, who has just merged with EXIT. So we're now going to be doing a lot more of these events, again, both north and south. Zeke, if you wouldn't mind saying a few words up here for us.
Sure. Good evening, everyone. Just wanted to first just let you know why why we have created this space. We created the space to ensure that we could have a place that on our side of town where we could have professional opportunities from a training perspective, as well as making sure that we have all the tools that are necessary so you get the right resources. And so when Nick wanted, well, we've been talking for a while about working together. And so I feel that EXIT brings a lot of the resources that are necessary. I think that we have the brick and mortar and the other technology that's necessary. So together, I think we can do some great things. And so with that, that's why you're here. Know that this place is open for you. We're here for the community. We're also here to ensure that that agents with EXIT have all the tools that are necessary and the space that's necessary, professional space as well as professional trainers. And with that, I'm going to give it up to Marla.
Thank you.
So as we begin, Marla's going to be doing the entire presentation tonight. You don't have to listen to me, which is it's awesome. I'll give you a little bit of background on why we selected Marla, though. Credit repair, there are lots of different places you can go to get your credit, quote unquote, fixed. But the important thing is you've got to understand what you need to do yourself in addition to maybe involving somebody else. When I did want to fix my credit and I wanted to start buying real estate, I was able to get my credit. Now it's in the 800s, but it was, as Marla knows, because she ran my credit back in the day, it was not in the 800s, nowhere near it. A lot less than that. I couldn't have probably gotten a stick of gum on credit. But Marla was the one that was actually there for me, that took me through the steps and said, Nick, you've got to pay down this, you've got to clean up this, open a couple of lines of credit and just use part of that credit. She's going to go into some of those details with you. And that's very rare. So you want to find a lender that's willing to do that. If you work with a credit repair specialist, make sure you Google them, check them out online, look at their reviews. But she's going to give you the information tonight to empower you to, whether you're a real estate investor, whether you're a first-time buyer, or you're an agent trying to educate people out there. Share this, please, with the public. For those of you guys out in Facebook land tonight, if for some reason we interrupt the signal, we'll be right back in a minute. So just keep sharing and sharing this. We want this all over everywhere. But Marla's been a huge asset to me, to EXIT. We've been working together now for a decade. Can't say that about a lot of people. She's been a wonderful friend to us, and I want to introduce her and have her attention for you guys.
Perfect. Thank you. Okay, so as Nick said, my name is Marla. I'm with Cross Country Mortgage. So I am a branch manager, I'm a senior loan officer, and I'm also a renovation loan specialist. So I do work a lot with investors and homeowners who want to buy properties that they can renovate and fix up. So I do deal with a lot with clients with credit challenges, and I have since I started in this industry 15 years ago. That's where I cut my teeth. Most of my business was actually right in these neighborhoods down here on the south side. So I cut my teeth on working with people building credit, and a lot of people who didn't qualify to buy homes, and so through that I learned what was needed and how to educate them and how to coach them through the process so they can get to the point where they qualified to buy their home. So we're going to spend most of the time talking about building credit, but first of all, I wanted to touch on the subtitle here, which is harnessing the power of credit, because building credit does take some work, some investment, some commitment. You're going to have to do some things, and I feel like when you have a challenge ahead of you that you're going to have to work hard at, it helps to have a purpose, to understand the why behind it so you're motivated and you can see the benefit in doing that. And so when it feels hard and you're like, oh, I got to work on this, I got to do this, you have that motivation because you understand what the end goal is and how that's going to benefit you. So obviously in this office we focus on real estate. So we'll talk about harnessing the power of credit specific to real estate. So we all know that owning real estate is more beneficial than renting. You're going to build wealth that way. And having credit allows you to do that. So when you're comparing renting to home ownership, obviously having the credit to allow you to buy real estate and build wealth is beneficial. So that's the first step, is to make sure you're in the point where you do qualify. And then the second level is improving your credit, because the higher your credit is, the better the loans are. So if you're comparing an interest rate of 4% versus 5%, how much is that going to cost you over time if you have to take a higher interest rate because your credit is not as good? So all that extra money you're paying is money that you're not building wealth that could be going into your pocket. So the first thing I want to do is actually show you contextually what it means to build wealth in real estate. This is going to be quick because I do want to focus most of the time on the actual building credit. But this is something that I feel like some people have a hard time connecting. Everyone knows that it's good to own real estate and it's an investment, but what does that actually mean? Where do you actually build the wealth? When you own real estate, you still have a monthly payment. You're paying your mortgage, similar to when you rent. You pay your monthly rent. So it doesn't feel like in the short term that you're connecting to where is that wealth coming from. I'm still making a monthly payment to have somewhere to live. So the wealth is built in the long term. So I want to just go through a quick example. So let's say you buy a house here for $200,000. So on the day you buy it, it's worth $200,000. And let's say you get a loan with 3% down payment. And we do have down payment assistance programs, so that 3% doesn't even have to come from your own pocket. But if you get it for 3% down payment, so on day one, your loan is $197,000. So that, or $194,000. So that $6,000 that was your down payment, that's what's called your equity. That's your value in the property. So you've put that $6,000 for your down payment, and then the rest is the loan, $194,000. That $6,000 is your value. If you were to sell that property the next day, in a vacuum, because of course there are closing costs, realtor fees, things like that, but just for simplicity, if there were no fees and you were to sell the property, you'd get your $6,000 back. So that's on day one. But what we know about real estate is we know that the value increases. So on average, real estate increases 3% per year. Now, of course, there's ups and downs with the market, but in general, an average. So let's plot this out, what that would look like, that 3%. So after 5 years, your $200,000 property would be worth almost $232,000. And after 10 years, almost $270,000. 15 years, $312,000. 20 years, $362,000. 25 years, $418,000. And after 30 years, your property is worth $485,000. So from your $200,000, if your property is now worth $485,000, and of course this is a long-term investment, we're talking about 30 years here, you have gained $285,000 simply for owning and living in your home, or if it's an investment property. So that's a substantial amount of profit. This is what we're talking about when we say that most Americans, their biggest investment is their home, and that is their biggest vehicle for growing wealth. So this is the first part of how you're growing wealth, is simply that the home is increasing in value. And again, this might be a bumpy line with the market. It might go up and down, but ultimately it's still going up. Like when you're walking on an escalator doing a yo-yo, the yo-yo is going up and down, but the escalator is still taking you up. So you don't really have to worry too much about market fluctuations if it's a long-term investment. Now, if you're buying and flipping, it's like day trading with the stocks, it's much more volatile. But long-term investments, it will go up over time. So then the second way that you also build equity, and again, equity is your value in the home. If you sold the home, the equity is what you would actually get. So the second way is that you're paying down the loan. So when you make a payment every month, in the beginning, the bigger portion of that payment is your interest. And your interest is the fee you're paying the bank. That's not an investment for you. You're just paying the bank their profit. The part that's the profit for you is the principal. When you're paying down the principal, you're actually paying down the loan. So the loan in this example started at $194,000. Every month you make a payment, that loan goes down. So your $194,000 loan after 5 years is now $177,000. So you have gained $18,000 of equity from making your monthly payments. And then after 10 years, you're at $155,000. 15 years, $128,000. 20 years, $361,000. 25 years, I jumped to the wrong line. That was the value. Okay, after 15 years, you're at $128,000. 25 years, you're at $94,000. 20 years. 25 years, $53,000. And 30 years, the loan is completely paid off. So now, not only did you have the appreciation of the value going up, you have the fact that you're paying the loan down. So after 30 years, not only do you have the $285,000 of the value going up, you paid down the $194,000 loan. So now you have the entire value of the property, the $485,000, that is now your equity. So if you're living in the home, you've paid off your mortgage, you're living there with no mortgage. If you sell it, you get $485,000. If down the road, eventually you pass away, your family inherits the $485,000. So you're not just building wealth for yourself. This is generational wealth that you are passing down to your family, that people are owning and not renting, and they're building value in their own communities. Okay, so there's a much bigger picture to owning real estate, right? That is all connected when you look at the bigger picture. So that's briefly again the why of how you're actually building wealth when you're owning real estate. And if you own your own home, you're doing this. If you own investment property, you're doing this. If you own multiple, you're doing it multiple times. So this serves multiple angles that you can look at, depending on what your comfort zone is. But that's something that the realtors here at EXIT have expertise in all those areas, whether you're going to live in it, whether you're going to buy an investment, whether you're going to buy a multi-unit building. You could buy a 3-unit building where you live in it and rent it. Then you've got the benefits of both sides of it. And, we have some clients who literally live for free because the rent covers the whole building. And so they're building the wealth and not having a monthly payment. So they're building up extra wealth that they're saving that they would otherwise be paying for rent. So a lot of ways within real estate to build wealth. But again, the first step is getting the credit. The credit is what allows you to do that. So the first step is to get your credit to the point that you can qualify. And then the second step is continue to build your credit to the point that you can qualify for better rates, both interest rates and PMI rates, so you save more money. So more of that wealth goes into your pocket or your equity in the property versus going to the bank as far as interest. So when you're looking to buy a home, most people, you're going to go to the bank and you're going to see if you qualify for a loan. So a lot of banks have different requirements for credit scores. So if you go to a bank and they pull your credit and they say, you don't qualify for a loan, your credit is not high enough, most people think that means they don't qualify for a loan. But that's not what it means. What it means, you don't qualify for a loan at this bank, because this bank has a minimum credit score requirement of whatever that number is. It doesn't mean you don't qualify for a loan. So if you know anyone who said they didn't qualify and they gave up on home ownership, have them do a second look, because there are different requirements from different banks. Some banks only want people with 640 score and better, because that's their specialty. That's all they want to deal with. I don't want to hypothesize about their reasoning for doing that, but that's what they deal with. They don't want what they consider the higher risk. And so some banks deal with lower. So the company I work with, Cross Country Mortgage, we don't have per se a minimum credit score. We have people who have scores in the 500s that we've gotten approved. So first of all, you want to make sure you're partnering with a lender that has the loan programs that meet what your circumstances are. And then the other thing is, most banks, when you go to apply for a loan, they give you 2 answers. Either yes, you qualify, or no, you don't. And that's all there is to it. So when I look at people calling to get pre-approved for a loan, I have 2 options, but those are not my 2 options. My 2 options are, yes, you either qualify for a loan, or you're not quite there, but here's your action plan of what you need to do to get there. So nobody gets a no for me, because I believe that everyone can own real estate. It's just a matter of educating people so they know what they need to do to get there. So whether your challenge is credit, your debt to income ratio, you need to save a little more money, you will have an action plan that will give you bullet points of what you need to do to get there. So in my home buying plan, it will give you an action step about credit, if that's your challenge. And a lot of those things we'll go through tonight on building your credit, but it will include that. Now, the difference between that and a credit repair company is a credit repair company is going to do some of those things for you. I'm just going to tell you what needs to be done. And then you can either decide if you want to do some of those things yourself or if you want to hire a credit repair company to do those. So they do serve a purpose if you want to work with those companies, and the realtors here at EXIT have connections with credit repair companies that can help. So if you want that extra step to have someone do some of the work for you, that's available as well. And then the last point on mortgages, and then we'll jump into the actual credit building, is that when I'm looking at these home buying plans, there's usually two factors. One is your credit, and the other is what's called your debt to income ratio. So your debt to income ratio is taking into account what are your monthly payments in relation to your income, okay? So the problem is that sometimes the actions you need to do to build credit are not good for your debt to income ratio and vice versa. So to come up with a plan that benefits both pieces of those and have your eye on the ball on both pieces. So you're building your credit, but you're also making sure you're keeping your debt to income ratio as low as possible so that helps with your qualification as well. Okay, so let's talk about credit. Let me get the clicker. Okay, and also I like this to be interactive, so if anyone has questions, jump in the middle. You don't have to wait till the end. Kind of flows a little nicer that way. Okay, so the first thing to know is that credit is not always intuitive. So there are a lot of misconceptions about credit. So the first thing I want to say about that is don't make any assumptions. If you think you know what you need to do to build your credit, make sure you consult someone who definitely knows, right? Because you may take the wrong steps. I can't tell you how many people have called me very proud that they have done things they thought that was good for their credit and they did the exact opposite things that they should have. One of the biggest misconceptions is paying off and closing debt. I paid off all my debt and closed the accounts. I'm ready to buy a house. Oh no, you just dropped your score 50 points. Sorry, that's not gonna work. So it's not always intuitive. Don't assume that what sounds good is good. Because again, back to the credit versus debt to income ratio, paying off your debt will help your debt to income ratio, but it's definitely not gonna help your credit score. And there are some things you should pay off and some things you shouldn't, and we'll go through some of those nuances. But definitely check in if you are not sure of the actions that you should take and get that home buying plan so you know for sure that you're taking the right actions. Okay, so the first thing we're going to talk about is open and active accounts. So most people assume that when we're talking about credit, we're going to talk about all the negative things, the collections and bankruptcies and all of that. And truly 60% or more of your score is based on your open and active accounts. So that is really the most important part, building up and maintaining your open and active accounts. Not that the negative stuff doesn't have any impact. We will go into that a little later, but this is really the important part, is establishing and maintaining all your open and active accounts in good standing. Oh, one other thing on the misconceptions too is a lot of people think that that credit scores sort of start at the top. Everyone starts with a good score, and as you make mistakes, it goes down. And that's really not the case. Everyone's score starts at 0, and you have to build it up. So that'll make a difference how you impact your score as well. Okay, so first of all, how many accounts should you have open? So the credit bureaus typically say the ideal number is 3 to 5 open and active accounts. If you have more than 5, that's fine, don't close them. Closing accounts is bad for you. Don't close them if you already have more than 5. But if you have less than 5, and you're building your accounts, there's no need to establish more than 5. I would keep it around that 3 to 5 range. Oh, so if you don't have any established credit, or you only have 1 or 2 accounts and you need to set up some more, there are a few ways to do that. So one, you want to apply for accounts that with companies that we know are more lenient toward people who are building credit. Some banks, and I don't want to name names, but some banks really only do want to deal with people who have great credit, and they will turn everyone else down. So you don't want to waste your time on those known banks that target only good credit. If you have challenged credit, we want to target the companies we know are more flexible to working with them. So for instance, like your Target cards, your Walmart cards, they will approve almost anyone. So that's a good way to build credit because we know those companies will accept lower credit scores. Capital One tends to be a little more flexible. So there are a few companies, and there are some resources to figure out which are which. So for instance, Credit Karma, if you guys aren't on there, I recommend that. It's a free service that allows you to track your credit. And they also have a few other services. And one service is that if you do want to set up accounts, they will make recommendations to you based on your credit because they see your credit. So if they know you have a 580 score, they're going to say, here are 5 credit cards that are likely to approve you. So they're matching you with companies that have a tolerance for where your credit is. Now, keep in mind though, Credit Karma does make money off advertising. So you still want to screen it yourself. You want to find the cards that have, for instance, no annual fees, no monthly fees. You don't want to waste money on stuff like that. But they will make that initial connection so you know which companies to start looking at. Some other ways to build credit accounts or establish credit if you don't have that 3 to 5 minimum. There is something called secured credit cards. So basically, normally a credit card, they just give you credit. So here's $300 of credit. You can go spend it how you want. A secured credit card, they consider you higher risk, and so they want to protect themselves. So if they're going to give you a $300 credit card, you have to give them $300. They hold your $300 in a bank account, and then they give you a $300 credit card. So it's serving the purpose of building your credit because you have a credit card and it's reporting to the credit bureaus, but they're holding your money. So in case you don't pay it, they already have your money. So those are useful if you need it. I would try first to not get those, but if you need it, go ahead, go that route. But again, screen them because a lot of those companies do intentionally take advantage of people with challenge credit, and they have ridiculous annual fees, monthly fees. So definitely screen those. A lot of the ones that advertise online are intentionally those kind of companies that are taking advantage of people. So like your regular banks often have secured credit cards, but they don't advertise that. But a lot of those don't have those fees, so you want to look into that. Another option is a cosigner. If you don't qualify alone, but you have a family member, maybe your mom or your aunt that has good credit, and they're willing to help you with this journey, you could ask for someone to cosign. And then one more thing is authorized users. So say someone has good credit. Let's say your grandma has fantastic credit, never pays anything late. If she adds you to her credit card as an authorized user, that credit card will now show up on your credit report. So you will get the benefit of all of her good hard work. You will get that benefit. And I know for a fact this works because my son, who's a college student, had not a lick of credit in his life. I put him on 2 of my cards, and now his score is way higher than mine. So it definitely works. Now you have to be careful though, because if they make a mistake on their credit, inversely, it will negatively affect you also. Once that's on your report, that's on your report. So you have to be careful who you're working with. And just because they made you authorized user doesn't mean they have to actually give you a card. Okay, so you're not talking about actually using the credit. You're just talking about building your credit, using it as a tool. So those are the options. Looking at companies that you know work with people with more challenged credit, secured credit cards, co-signers, and authorized users. Okay, go ahead.
So pretty much you can ask someone to sign you on to their credit card. They never have to give you a card.
Correct.
But you'll reap the benefits of their good credit.
Exactly.
And so it would just be like, I mean, there's nothing that they have to trust you about because they're not giving you a card, right? It's just pretty
I mean,
much
I don't know. I'm not malicious, so I haven't sat down and thought, well, okay, I'm on it. So is there a way I could use it without being actually on the card?
Yeah.
You know.
No, what I'm saying is that it would be an okay incentive because it's not
Right.
like they're actually having to give you a card that you can actually use.
Right.
They're just helping you out in the long run.
Yeah. But again, I do still want to make a point about cautioning that if they mess up, you mess up too. So you do want to be careful of who you're asking. Make sure you trust that they're, that they're responsible. Go ahead.
How long would it take for that to actually go into effect?
Yeah. So basically, credit cards typically, well, all loans typically report once every 30 days. And so as soon as it reports, it will impact your score. Authorized user cards, as soon as it reports, it's like you've had that account open for as long as the other person did. If it was an account they had open for 10 years, you automatically have a 10-year history of perfect credit, right? So now if you're opening a new account or going the route with a cosigner or a secured credit card, those, again, will report within that 30 days, but it will only have that 2-week history because it is actually a new account. So that will help, but the history won't be as long. But they will, once they report immediately, and I definitely recommend using either Credit Karma or there are other similar sites. I'm not necessarily endorsing them, but it is an easy one to use. So you can see the progress. Credit Karma allows you to refresh once a week. Some companies allow you to refresh daily, but you can track it and say, okay, I know I opened this card, and then you pull your credit, you refresh it a week later, and you see the card report, and you see your score jumped 30 points. So you can track it and see the progress, so you know you're headed in the right direction, and that also incentivizes you to keep going, because you see the benefit. You know, it helps you to keep motivated. Go ahead, 2 more questions.
So when you add someone to your credit card, do you have to let the credit card people know that you?
Yeah, so that's how you have to do it. You have to call.
Right.
So the person whose credit card it is has to be the one to call and say, I'm adding my nephew to the card. Here's his name, social security number, everything.
Right, but I'm saying when they report it to your credit, do you let them know that to report it to both of them? Or
No, they'll do that automatically once you're on it. Yeah.
So what if they have a bankruptcy? How?
So the only thing that's reporting is the specific card you are added to. You're not getting their whole credit report.
Right.
So if they have a good card that's in great standing, that will report. If they also happen to have a bankruptcy or anything negative, that will
You know
not
what I'm
report.
saying? The person who had, is trying to rebuild their
Oh,
credit
yeah.
has a bankruptcy.
Yeah, that's
that
fine.
would be good.
Yeah, absolutely.
Okay.
No, and that's definitely something we're going to touch on. The most important thing with bankruptcy is rebuilding afterwards. So many people after bankruptcy stick their head in the sand. They're like, I'm done with credit. I tried it. It didn't work. Or they're ashamed and they don't want to try. They're afraid of getting rejected for cards. The most important thing is to rebuild it. So definitely these same tools are absolutely good in that situation. Okay, so 3 to 5 accounts you want to open. How long have your accounts been open? So again, as we talked about a little bit in the last section, is the longer they're open, the better. If you have accounts open for 10 years, that's going to help you more than accounts open for 2 months. But it's still going to help you. I'm not saying don't open new accounts. But what they're going to do is average the accounts. So if you have accounts that have been open for 10 years and accounts that have been open for 1 year, it'll say your average accounts have been open 5.5 years. And that's what they're going to use to calculate that part of your score. So the longer it's open, the better. But this is also the main reason why it's important to not close any accounts. So let's say you had an account open for 10 years and you decided to close it. So now your average length of time is not taking into account the benefit of that long history that you had established. So we definitely do not want to close accounts. That's definitely very harmful for your score. And then opening accounts. If you're not at that 3 to 5 number of cards we want, you want to open accounts. But once you get to that point, you don't want to, because every time you open an account, now you're resetting your average length is now they're averaging in a new account that's only been open for 1 month. So it's going to keep dropping that average time, right? And this is one of the more minor factors. Some factors affect your score greater and some less. So this one it affects it, but it's not as great as some of the other factors we're going to talk about. So it is more important to establish the accounts than to worry about the length of time. But you should know this so that as you're planning for the long term, you can make sure you're keeping the accounts open, not constantly opening new accounts, just open what you need and be done, and definitely not closing accounts.
Excuse me. So with opening accounts, just applying for them, and you don't get approved, don't that make your score down?
That is going to come up in another section about credit inquiries. Yeah, we're going to talk about that. Yeah, that can have an impact. Okay, so that's all in that section. And then with the length of time too, the authorized user accounts help too, right? Because again, if they're 10 years on that account, that's going to average all your accounts and increase your average length. So, okay, so the type of accounts. So there are numerous different types of accounts. So, so the first and most common is what's called revolving. So if you picture a revolving door, and you go in, you go out, you go in, you go out. So that's how your credit is. On a credit card, you can borrow the money, pay it back, borrow it again, pay it back, borrow it again. It's cyclical. So revolving credit is one type of credit. Another type is installment. So that's like your car loan. Once you pay down your car loan, you can't just go borrow the money back. It's just a straight loan that you pay down over time, and that's all it is. So those are the main 2 types. So installment loans are your car loans, your student loans. Mortgages are technically installment loans, although they have their own category, just being mortgages. Revolving is mostly your credit cards. Also, if you have lines of credit. And then also on installment are unsecured loans. If you have any unsecured or personal loans, those are installment loans too. So the credit bureaus like you to have a mix. Some revolving, some installment. They like to see that you're responsible with different types of debt. You can handle it. Because again, your credit score isn't starting at the top and only getting knocked down for errors, it's building. So they want to see, that's why people who have no credit have bad scores. They think, well, I didn't do anything wrong, why do I have a bad score? It's because you haven't shown them that you can responsibly handle credit and make your payments. So they want to see, can you handle a car loan, make your payment on time every month? Can you handle a credit card? Can you handle all these different types of debt? So a mix is the best. Now, with that being said, I don't recommend setting up debt just for the purpose of building, okay, let me say again. I recommend setting up some debt for the purpose of building credit. But don't go out and like run out and buy a new car because you're like, she said I need a car loan, because now your debt is higher, right? So we have to, again, balance the debt with the credit. And we're not opening credit for the purpose of accruing debt. We're opening credit for the purpose of building your credit score. So we want to be careful that some people are like, she said I need 5 credit cards, and then you run out and go shopping. No, that is not the purpose here at all. It's just to build credit. So if you don't need a car, if you don't need a student loan, if you don't need an unsecured loan, don't go do it just to build your credit. So you want to be a little bit careful about those things. Now, credit cards, you can open a credit card and not have to spend money on it, right? So you can still get credit without getting debt. Okay, so we want to make a distinction between that. So yeah, so they do like a mix of the accounts. Okay. All right, so how are we handling the accounts? So the most important thing on any type of account is that the payments are on time. So the easiest way to do that is to set it and forget it. With technology nowadays, there's so many ways to make automated payments, whether it's through that company's website, whether it's through your bank website. There are so many ways to make automated payments that there really is not an excuse to forget your payments. You really need to set it up in a way that you can't say like, oops, I missed it that month. Making one late payment when you are in the process of building your credit will hurt your score more than you will be happy with. When you pull up that Credit Karma that month, you'll be like, oh, I was doing so good, and then you see it. It's going to hurt. So this is the most important thing, is making sure every payment is on time. One late payment will have more damage than you would like. And the tricky thing with this section about how to handle credit is that education only goes so far. But when I give you education, you need to change the habits, right? The behaviors, and that's the hard part to change. It's easy to come to this class and hear this, but when you go home, you have to implement the behaviors to make this work for you. So having to change your behaviors, say, okay, I need to make sure all my payments are on every time, and set up reminders in your calendar, or just set it and forget it. Put it on the automatic payment. But whatever you need to do, you have to do something proactively, whether it's setting the automatic payments, making calendar reminders, getting text reminders. I mean, there's so much stuff with technology that it can remind you, or if you even have paper calendars or journals, put it in there. Whatever you need to do, you need to change that behavior. Not just know in your head you need to make them, but change your behavior so that it's actually going to happen. So that's the hard part with that. So on-time payments. So let's talk about revolving credit. Revolving credit is one of the largest impacts on your credit score, one of the easiest ways to build your score up, and one of the easiest ways to damage your score. So everyone has heard the term maxed out credit card. Yes, anyone not heard that? Okay. So basically, your maxed out credit card, in case anyone on Facebook isn't familiar with this, is when you spend the entire credit limit. Let's say I have a credit card with a $1,000 credit limit, and Christmas is coming up. So I got to get everybody a present, so I go out and I max out that card. $1,000 I've spent. Now, my usage, your usage is your percentage of what your balance is in relation to the limit. If your credit balance is $1,000 and your limit is $1,000, your usage is at 100%. That is called maxed out. I would even say that if you're at 90%, that's still basically maxed out. That is incredibly damaging to your score. But the good news is it's reversible damage. If you pay it down, your score will go up immediately. It's not the kind of damage that's permanent. Some damage, like if you make a late payment on one of your loans, you can't reverse that. That's not going away. You pay it on time the next month, and that's great, but that late payment is still going to report. Whereas with a maxed out credit card, if you pay it down, there's no permanent damage to it. You pay it down, and the balance is low, and you're great. So again, if you have that $1,000 credit card, and you pay it down, now your balance is $100. $100 in relation to $1,000 is 10%. That is your ideal. Write that down if you're taking notes. 10%. You want your balances to be 10% or less of the credit limit. Now, if you Google credit repair or talk to other credit repair people, some people will tell you 30%, and 30% is good. 10% is better. I'm telling you, if you track it on Credit Karma, set your credit cards with a balance at 30% and see what it is, then set them to 10% and pull it again the next month, and you will see it is better. 30% is good. The lower it is, the better. So if your credit cards are at 90%, if you get them to 70%, you'll see an improvement. 50% will be better, 30% will be better. Under 10% is the best. So that's the target you want to be. So that is, again, the fastest way to improve your score, and it's also the fastest way to damage your scores, maxing out credit cards. So do not max out your credit cards. So if you're timing your credit cards for when they're going to report to the credit bureaus, they report to the credit bureaus on what's called the statement end date, or sometimes called the cycle date. So your credit card will say your statement is from March 15th to April 14th. Okay, so that's not the day the payment is due. That's the date they actually close the statement and mail you the bill. So that end date, whatever that last date is that the statement closes, that's typically most credit card companies when they report to the credit bureaus. A few have their own schedule, like some just report on the last day of the month, something like that. But most of them, it's at statement end date. So if you're tracking, so let's say you spend on your credit card that month, but you don't want it to damage your credit score, just pay it before that statement end date. Pay it before it hits the credit report, then it won't affect it. So it's not saying you can't spend on the credit card, it's just what is the balance on that date. So that's the important thing with that. Okay, and then also with your revolving credit, the higher your available credit, the better. So if you have a credit card with a $500 credit limit, and you call the company and say, hey, can I get a credit limit increase? They say, how much do you want? Well, I always say $30,000, because even if they're not going to approve it, then they'll counteroffer with whatever the max is. So say you say, I want $30,000. They go, we're not going to give you $30,000, but we'll give you $3,000. So now you've increased your credit limit from $500 to $3,000. Your credit score will improve without anything. You don't have to make a payment at all. And let's say in that same case, let's say your credit balance had been $300. So your $300 credit balance, did I say limit? I meant balance. $300 balance in relation to the $500 limit before, you were at 60% usage. But now that the credit limit has gone up to $3,000, your same $300 balance without making any payments is now only 10% of the limit. So you've reduced your usage, and you've also increased your available credit. What is that? $2,700. The higher your available credit, the better it is. So I always ask for credit limit increases pretty regularly. Every 6 months, every year. There's no harm in doing it with some credit companies. Some credit card companies, they'll just look at it and tell you yay or nay. Some will pull your credit every time you do it. So when we get to credit inquiries, we'll talk about that. But yeah, if you can keep boosting that score up a couple thousand every time, and then you get up to $10,000 limits and $15,000, $20,000 limits, the higher your limits are, the better your score is. Again, regardless of whether you spend it, just having that available credit, the message is that these credit card companies trust you. They're giving you a lot of available credit. And if they trust you, other companies will trust you. And therefore, you're trustworthy. And more people should give you loans. So once you get to that spot, you know, the message is out, you get more credit. And it's cyclical from there.
To go back just a little bit, I know you talked about the being maxed out.
Yeah.
What about having one maxed out card versus
spreading it out?
Yeah.
Yeah, good question. So, okay, so this is actually important because this is something people do a lot. You get your 0% balance transfer offers. Anyone get those in the mail? You guys know what I'm talking about? Great. Who doesn't want 0%? I want it. I take it all day long. It is great for your debt because if you had switched that from a credit card that was at 25% interest, you're going to save a lot of money. It's great for your debt. But again, what's great for your debt is not always great for your credit. You still now have a maxed out credit card. So they do take into account both. They take into account each individual card if it's maxed out, and then they also take into account the balances on all your cards in relation to the balances on all the limits. But it is better to spread it out. It's better to have 4 cards with 30% usage than 1 card with 100% usage. But man, those 0% offers are very tempting. So you gotta balance it. I mean, sometimes it's worth it, or maybe just go up to 50%. You know, if you're gonna save money, shifting debt around does make sense. And speaking of shifting debt around, let's talk about shifting debt from revolving to installment. So let's say you have a total of $20,000 on your credit cards. Over 4 or 5 cards. They're just, you know, they're all maxed out. You've built them up over time for whatever reason. You have $20,000 of credit card debt. if you open a personal unsecured loan, which is an installment loan, not revolving, for $20,000, and you use that $20,000 to pay off all of your credit cards. Now, you started with $20,000 debt, you ended with $20,000 debt. You have paid off no debt. This costed you no money, right? Your credit score will probably go up. I don't want to guess numbers because I'm on Facebook Live. If it wasn't on, I would guess because I don't want to be held accountable. But let's just say a substantial amount. Your credit score will go up a substantial amount simply for switching the type of debt from revolving to installment, even if the debt is the exact same amount of money. Does that make sense? They just really do not like the maxed out revolving debt. You guys have heard the phrase that when you don't need money is when the banks want to give it to you. You need to look like you don't need money. If your cards are maxed out, it looks like you're struggling. It looks like something is wrong. You're having financial hardship. Otherwise, why would your credit cards be maxed out? You have to think like a banker, right? If you have a credit card for $10,000 and you've only spent $200, they're thinking, well, you don't need your credit. You're not in hardship. Let's give them more debt. That's when they want to give it to you. So that shifting is something I do a lot. And you'll see that if you work with me for your home buying plan. It's something that I recommend a lot because it is the quickest way to boost your credit score. And oftentimes, it also improves your debt to income ratio. Because if those credit cards were at 25, 30, sometimes 35% interest, and you shifted to an unsecured loan that might be 7, 8, 10, even 13% interest, the monthly payment is still likely to be lower. So you're going to help your debt and your credit in that case. So that is definitely something I do a lot. But again, like any credit, you want to shop around for it, right? Because unsecured loans are not created equal. Now, I'm not recommending your payday loans. I'm not recommending your car lien loans. They make it sound great. It's only 1% interest per day. That's 365% interest. They make it sound good with their marketing. So I'm not recommending those. But a regular bank, if you walk into a regular bank or some of the banks that have credit cards, and again, depending what your credit score is. If your credit score is low, the cost of that credit is going to be higher. But you can use credit to build more credit. So let's say your score is right now 580. And so you're going to try to do this. So you're going to get this unsecured personal loan, but your score is 580. So they're offering you like a 20% interest rate. And you're like, Marla said I shouldn't do that. High interest rate, that's terrible. But what if you do that and then you pay off your credit cards? Right? What happened to your credit score? It went up. Now you can qualify for another unsecured loan at a better rate and pay off the bad rate one. So if you're going to keep that loan with 20% interest rate forever, now that's a terrible deal. But if you're going to keep it for 2 or 3 months so that you can boost your credit and then get a better one that's lower and it's just a stepping stone, why not take advantage? But you have to be diligent and make sure you're hitting that goal. Don't forget and leave that 20% account open forever. So that is definitely one of my biggest secrets and something that I'm always surprised that more people don't know. And just so you know, if you are talking to other banks or you have talked to other banks, loan officers are not trained in this. Your average loan officer is not going to tell you how to fix your credit. They don't know themselves. Most of them have bad credit themselves. I don't want to say most of them. Some of them have bad credit themselves. And I know because some of them come to me, to help me with their own credit or to help me with their clients, okay? So this is not a normal thing. Mostly you have to go to credit repair companies to get this information. This is something that I have studied, outside of my normal job so that I can learn it and be an asset to my clients and help everyone else. But it amazes me things like that, like shifting debt from revolving to installment, that's not more of a common knowledge kind of thing because it's just so impactful and so immediate. It's not the kind of thing. Some things with building credit take time and you got to wait a year or 2 years and it's slow going. Some things are immediate. Getting those credit cards out from being maxed out, you'll see a huge jump. And again, I'm not going to estimate, but I've definitely seen, I can tell you some case studies. I mean, I had one client who had a maxed out credit card and we shifted it to an installment loan and it reported to the credit bureaus within that week and his score went up 90 points. That was just one credit card that was maxed out that he paid down. Not paid down, but just shifted it. 90 points. That's one example. So I'm not guaranteeing yours is going to go up 90 points, but it is a very substantial impact and very, very quickly. Okay. So we've talked about making sure you have on-time payments, not maxing out your credit cards, getting the highest credit limit you can, not closing accounts, only opening accounts till you get to that 3 to 5, and then not opening too many and not closing. Again, I said that twice, but very important, don't close accounts that have long histories. Okay, so then let's talk about, credit inquiries. So this came up a little bit earlier. So credit inquiries. So credit inquiries, yes, it can hurt your score. Most people know this, but again, some things impact your score a great deal and some things a little bit, okay? So a maxed out credit card, again, we're looking at a substantial amount of points. A credit inquiry, we're looking at 2, 3, maybe 4 points. So not a substantial impact. So yes, you should be aware that too many credit inquiries can hurt your score, but you shouldn't let it limit you because you need to do credit inquiries to do these other things. So to open new accounts, to increase your credit limits, you need to pull your credit to do those things. So don't be afraid, oh, the inquiry is gonna hurt my score. Well, if the inquiry is gonna hurt your score 3 points, but opening a new credit card or getting a credit limit increase is gonna boost it 20 or 30 points, well, that's a net gain. That's worth it, okay? So you wanna do that. If you can, it's good to do it in a concentrated period of time. If you pull your credit a ton, but all within a week's period of time, sometimes the credit bureaus will only count it as one inquiry because they know you're shopping around. Like for instance, let's say it's all car loan companies. They know you're shopping around for one car loan. You didn't have 10 inquiries because you're trying to buy 10 cars, right? So if you do it in a concentrated time, often they will only hit you once, not 10 times. Now, if you're doing this over a period of 3 months and you keep doing it, you're gonna keep getting hit. But again, you wanna weigh that net gain and you wanna weigh the odds of that net gain. Now, if you're going to one of these banks that is known for only approving credit with very high credit scores and you know you have a very low credit score, right? Well, that's gonna be an inquiry that's just a waste of your 3 points, right? Because it's not likely they're gonna approve it. So you wanna do a little due diligence to make sure that when you do use your inquiries, you know, like a silver bullet, you wanna make sure you're gonna get your bang for your buck back. Otherwise you lose 3 points without gaining the 30 or, you know, again, estimated numbers, not exact numbers, not promising any results, but so inquiries, you want to be aware of them, not do too many, but don't be afraid of them because you need to use them in order to get where you want to be with the rest of these goals.
So you can just go in any bank and you don't gotta have no account with them and try to apply for a credit card?
Yeah, you can. Most of them have websites. I don't know that they have in the physical bank. Some of them don't have like a banker that does that. Sometimes they do, sometimes they don't. Sometimes you'll go in the bank and they'll say call our 800 number because that division is based in some other state or country or who knows where it would be. But yeah, most banks have credit cards. But the question is which banks have the more lenient ones and the less lenient ones. And a lot of those banks also have the secured credit cards if you have to go that route. Regular banks do. So again, just avoid the fees. Now, interest rates, if you're gonna get a credit card with high interest rates, which most of them have high interest rates, I don't mind that as much if you're gonna pay it off every month. A lot of people don't understand how credit cards work, but if you pay off the balance in full every month, you know, they give you that minimum payment because that's what they want you to pay. Because if you make that minimum payment, they are making a ton of money off you. But if you pay your full balance every month, you don't pay any interest. It's free money they gave you. You went out and spent $200 and you paid $200, no interest, it was a free loan. You pay your minimum $20 payment, interest is hitting over and over every month. Interest on the balance, next month interest on the balance, and the interest on the balance, you know, so you're paying a lot of money for that. So if you're paying it in full, I don't care if your interest rate is high, but those fees you're gonna get hit no matter what. You know, some of them have an annual fee, $100. That's just a waste of money. Some of them have monthly fees. I had one client, I don't remember who it was, $12 monthly fee on the credit card. Every single month, hitting $12, $12, $12. So they're just taking advantage of you there. So go ahead, you had a question?
Oh, so when it comes down to paying it down or paying it in full, does either one have like an advantage or give you more points or less points, or do they give you the same amount of
Between
points?
what?
Like, so if you pay your account down in full, does that give you more credit points than if you were to just pay it down to 10%? Or is it just the same? You know?
Oh, between 10% and 0? Okay, that's actually a good question. So they like to see that you have a little balance because it shows that the account is active. If all your accounts are at 0, it just looks like it's not active. So I would leave a small balance on like 2 or 3 accounts just to show it's active. Yeah, but again, you can still pay your bill in full because the date it's reporting is the statement end date. So if you pay your bill in full so you avoid paying interest, which again is a waste of money, everyone agrees with me there? Anyone want to make the credit card companies rich? Is that your goal in life? Anyone? No. Okay, we don't want to do that. So we want to pay it in full. So you could still pay it in full, but then come the statement day, say you went out and filled your car with gas, you got 20 bucks on it. That little balance will help a little bit just to show that it's active. So, and then something else I do with credit cards, if you're using your credit cards just to build credit, again, not to accrue debt, just to build credit. First of all, buy things you're otherwise going to buy. Don't be like, well, I have credit, I can go buy, something luxurious you weren't going to buy anyway. You're going to fill up your car with gas. You have to get to work, right? I mean, some people take the bus, but if you have a car, you're going to fill it up anyway. So this is money you were otherwise going to spend. You're not spending extra money, so you're not accruing debt, but you can do that once a month. Fill your car with gas. Put the card in a drawer. Don't use it again for that month, right? Wait till the statement comes, bill comes, pay it in full. Next month, take it out once a month, go fill with gas, do it again. So you're using it to build credit, not accrue debt. So you're always just gonna spend a little bit. It's 20 bucks to fill gas, or maybe 30 bucks with the gas prices going up, right? If your card is at least 300 bucks, that's still under that 10%. So it's a tool. This is a vehicle to build your credit. But it can be tempting, and I have had clients who say, I understand that I should open credit cards to build my score, but I don't want to because I know myself, I don't trust myself. I know if I have that credit card, I'm going to go shopping, I'm going to get 10 pair of shoes, and then now I'm not going to get the house, right? So you have to know yourself, you have to be disciplined, and you have to keep focused on what is that goal, and not be tempted, there's this new video game out, I don't have any money, but that credit card Marla said I should get to build my credit, I could get it on there, right? So part of it has to do with, again, discipline and behavior and training yourself. And again, back to why we're focusing on the purpose to kind of help motivate so you can stay on track with that. Did I miss any other questions? Yeah.
So is there such thing as a hard or soft inquiry?
Yes.
How does that?
Good call. Yeah. So hard inquiries are the only ones that affect your score. So a hard inquiry is if a company is actually pulling your credit to open a new account. So like if you apply for a loan with me, that's a hard inquiry. You apply to open a new credit card, that's a hard inquiry. Soft inquiries don't have any impact on your credit. You can do those all day long. So when you pull your own, if you're looking at your Credit Karma, soft inquiry, it's not going to show up anywhere. Credit card companies do soft inquiries on you all the time. If you already have an account with them, that's how they determine if they're going to increase your credit or cut your credit or whatever. So they're constantly checking on the back end. That's where they give you, they have these advertisements. The credit cards are like, hey, free credit score. Because they're already pulling the soft inquiry anyway. They already have that information. They're just now sharing it with you. So yeah, soft inquiries are perfectly fine. Now, just so you guys know the legality, to do a hard inquiry, they need your authorization. If you see a hard inquiry on your credit report and you did not authorize that company, either verbally or in the signature when you sign the disclosures, call them and they will take it off. That is against the law. So you have to be aware when you're authorizing a hard inquiry, you should know that you're doing it. That's definitely something that you should require. Okay, any other question before we jump into the next section? And I need a drink real quick. No, we're good. Everyone following me? Anyone learn anything yet? Raise your hand if you learned at least one thing. Okay, good. All right, so next time I see you guys, everyone has 800 credit score? You guys wouldn't believe it, but talking makes you so dry. I'm sure some of you have done this before, but I always forget how bad it is. Okay, let's move on to the next section. So this is the part that most people were expecting to learn about, all your negative stuff. And people think this drives your score. And yes, it does have an impact, but again, this is less than 40% of your score. 60% or more of your score is all those open and active accounts. So the stuff we've talked about this up to this point is the more important stuff. So yes, we'll talk about this, and yes, you need to also know it, but focus on those open and active accounts. Make sure you have the right number, the length of time, not maxed out. All that stuff is the most important part in building your credit. Okay, so first you have all your legal stuff, right? So you've got your judgments, your bankruptcies, your foreclosures. These are things that happen. Unfortunately, they happen to good people. They happen to a lot of people in the recession. That was just the nature of how it was. And a lot of people you wouldn't expect. Watching people walk down the street, a lot of people had credit challenges that you wouldn't know. And so a lot of people ended up in these situations. So the thing to know is, again, what I mentioned before is rebuilding after those situations. They happen. Don't stick your head in the sand. Don't just say, I'm done with credit. I tried it and it didn't work. Rebuild. Day one, when you're out of that situation, go set up the unsecured credit card. Get signed up as an authorized user with a family member. Whatever you need to do, the things we went through, rebuild after these things. Some of these things will be an impediment to buying a house and some won't. And it depends which loan you're using. So if you've had hardships, chances are the loan you're going to get after that is FHA. Because FHA is the more lenient with these situations. There's typically waiting periods. So for instance, bankruptcy, if you had a Chapter 7 bankruptcy, FHA allows you to get a loan after only 2 years. That is one of the lower waiting periods. Conventional will be a lot longer, okay? So 2 years, in that 2 years, you're focused on building your credit. The other thing with FHA is it's a low down payment, right? So if you can get your 3.5% down payment and use the down payment assistance, and you only have to wait 2 years after the bankruptcy, that's probably gonna be the best deal. We do have some specialized loans that will allow you to get a loan the next day after any of these hardships. You don't have to wait at all. But there are downsides of that. Those are higher risk loans. You need much higher down payment and much higher interest rates. So chances are if you just got out of a bankruptcy, you're not gonna have 15, 20% down payment. So those loans are available. We should explore them. But chances are the waiting period is gonna be the main thing that happens after these events. But you still wanna get that home buying plan now. You don't wanna just say, well, Marla said I can't get a house for 2 years, so I'm not gonna call her for 2 years. No, you wanna call me right away, get your home buying plan. Work on rebuilding your credit, work on saving your money, whatever it is that I give you in that home buying plan, that 2 years gives you time to do that. And even if you haven't had one of these hardships, I recommend getting the home buying plan at least 3 to 6 months before you're ready to buy a house, because then you have time to do these things. If you call me and say, I wanna buy a house today, I found the house I wanna buy, there isn't time to react to any of these situations. It's either you qualify or you don't based on what you have today. I can't say, okay, do this with your credit and pay this off and shift this debt over here. There isn't time. So you want to have at least a 3 to 6 month window to work on those things. But then specifically with something like a bankruptcy, you've got a guaranteed window because you got to wait for the FHA loan anyway. So Chapter 7 bankruptcy is 2 years. Chapter 13 is a little interesting. You can actually get a loan even while you're in it or right after it. There isn't a waiting period, but there's some nuances. So if that's your situation, we can talk about it offline. I don't want to focus the class on it. But again, you still have had to rebuild your score. Short sales and foreclosures for FHA are 3 years. So again, you want to focus on building that. Now, the other thing to do is if someone is in a situation where they are considering doing a bankruptcy or a short sale, they want to talk to me before that, because you want to weigh that, right? If that's going to be an impediment to waiting 3 years to buying a house versus maybe there's another way that's not bankruptcy, you want to weigh the costs of those two options before making that decision. So definitely talk to me before. Judgments. So judgments either need to be resolved or on a payment plan. You can get those on payment plans and qualify. I have one attorney I work with who's actually really good at negotiating those. So yeah, if you have judgments, for the most part, you want to get those taken off, because in addition to the qualifications for the loan, they are going to be hurting your score more than some of the other things, because the legal things fall in a section called public record, and those are more damaging to your score than other things. So for the most part, you want to at least get over these things, sort of rebuild. And again, for the judgments, and this is true for collections too, which is on the next page, is we don't require that you pay it in full. If you negotiate and settle for less than owed, the important thing is that it's zero balance. Okay? So whether you do that yourself, you hire an attorney to do it, you hire a credit repair company to do it, the important thing is that the balance is zero. It doesn't matter how you get there. So if you have a $10,000 judgment or collection, and you're able to negotiate them down to $2,500, $3,000, more power to you. That's $7,000 you have for your down payment. So there's a chance that paying in full might be slightly better for your credit score, but I've not noticed any substantial difference that I would recommend blowing a lot of extra money that's unnecessary. And I'm not really taking a legal position on this with these companies, but if you learn the background of these companies and how they work, they're making a ton of money off you. So I never feel bad negotiating debt down with them, right? They're buying, so if you have a $10,000 debt, they probably bought that for $500 or $1,000. So even if you paid them $3,000, they made a bunch of money, even if it wasn't the full $10,000. So the main thing is just to get rid of it so it's zero balance. Now the tricky thing though is sometimes they will negotiate and say, okay, you can pay $3,000, but they'll still record that other $7,000 that you owe it. Like it's a charge off and they'll still put on your credit report, like we charged off $7,000, it's still a past due balance, we accept it. So you wanna make sure that it's gonna show zero balance due when you're done with however you're negotiating it. Zero balance due is the main end goal. Okay, so then we have the other items that aren't necessarily public record, but we've got our charge-offs, our collections, repossessions, late payments, other unpaid things. So collections, so again, looking at it from two different lenses, one lens being what's good for your credit score, and the other lens being what you need to qualify for a mortgage. So for your credit score, getting them all to zero balance is obviously best, okay? But again, some things have more impact on your score than others, right? So a maxed out credit card is actually gonna hurt your score more than a collection in most cases, right? And it's a little hard to say, and this is why I don't say exact how many points this and that, because it's different for everyone. Let's say both of you have a credit card that's $5,000 and you both pay it down to $1,000. Your scores are actually gonna change differently because the way that the scoring model works is it takes into account your whole credit report, right? So it's not just one isolated account, so it'll affect different people differently. But for the most part, if you pay off a collection, it's still gonna show on your credit report as a collection. It's just gonna show a zero balance collection versus a collection with, $2,000 or whatever it is. So now if you can negotiate that they actually take it off your credit report, that will help your score more. But if you just negotiate and it's zero balance, but it's still a collection, your score is not going to increase a ton. It will increase some, but if you're selectively only have a certain amount of money and you're like, should I pay down a maxed out credit card or should I pay off a collection, the maxed out credit card is probably going to have more bang for your buck. But when we go to the other lens of what you need to qualify for a mortgage. So again, assuming that we're looking at an FHA loan because it's the most lenient on credit, your total collections cumulatively need to be less than $2,000 balance. If they're over $2,000 balance, then we need to get rid of some just to qualify for the loan, regardless of what your credit score is, right? So that's why I'm saying there's like all these overlapping things. There's mortgage qualifications, your debt to income ratio, your credit, and so we have to take all those different factors into account. If your collections are less than $2,000 and your score is high enough to qualify, you may not need to pay them off to get the loan. And depending on the situation, your money may be more advantageous as a down payment than it is to go to that collection. So it's not always guaranteed that you should pay off all the collections, especially what the timing is. If you're looking to buy a home within the next 3 months versus if you're thinking 3 years down the road and you have some time, okay, then pay things off. It will help your score. I'm not saying it won't help your score, but you just want to weigh all these different factors. Charge-offs, again, as long as it says zero balance is fine. If it's still showing after a charge-off that you have a $4,000 balance, that's likely going to be a problem. There's different nuances with different loan programs. Some programs it's problematic, some it's not. But for the most part, if you have a substantial past due balance, even if they charge it off, so they wrote it off on their taxes, they don't, they're not claiming on their books that you owe them money, but you have that extra debt still showing, that could be a problem. That's actually very common with repossessions. Repossessions often show balance because we know that cars, unlike houses, are depreciating assets, right? As soon as you drive that car off the lot, the value goes down immediately. So likely your car is underwater as far as the value. Let's say you buy a car for $20,000, you get that loan for, let's say, $18,000. As soon as you drive it off the lot, it's only worth $15,000. So your loan is already higher. If you got repossessed on that day, they take your car, they can only resell it for $15,000, you still owe them $3,000, even though you don't have the car anymore. Okay, so that past due balance that they're gonna try to hit you for, that typically needs to be resolved. And again, you could pay in full if you feel like being generous. You can negotiate with them and pay for less. As long as it shows up zero balance, that is the goal that we're looking for. Late payments, again, that's something that's just not reversible unless it's an error. And some of these credit repair companies will submit letters and say, hey, it's an error, we dispute, and sometimes they'll come off. And sometimes they're actually errors, sometimes they're not. They're just going to dispute them. You know, that's between you and your credit repair specialist if they want to do that. But for the most part, they've gotten much stricter on that. It used to be if you just dispute, it would come off. Now they're like, no, the law says if it's actually late, we have to report it. Even if you dispute it, unless it's legitimately an error. If you show it's legitimately an error, they'll take it off for the most part. But for the most part, late payments are just going to be there. You can't do anything about it. So if you already have them, don't beat yourself up over it. Just don't have any more, right? Again, set those automatic payments, put a calendar reminder, whatever you need to do to not have any in the future. But you definitely want to avoid those because it's not reversible. Unlike a maxed out credit card that you can pay down, you can't unlate a payment. Once it's late and it's on that credit report. Unpaid income taxes is a problem. You can get on payment plans, but that can be a problem. Unpaid child support is something I see once in a while. You know, the state of Illinois, they will report that as a collection on your credit report. So, you know, that can be an issue. So all of these things are potentially issues. Obviously, you want to avoid them. If you already have them, this is where if you have a lot of these, you may want to work with a credit repair company. So they are going to charge you a fee for that, but you know, in the end, it may be worth it. You can take your time and send these letters in dispute. I'm sure you can find templates online if you Google it. So this is the part that is work. If you're going to try to get these off or negotiate them down if there's balances, this is the time-consuming part of building credit. Again, depending on how bad it is, it may be necessary, it may not be necessary. It may be beneficial, or it may, you know, be more beneficial to save the money for down payment. But this also, in addition to taking time, it typically takes some money because you have to settle it for something, right? They're not going to take no money. So it is what it is. Any questions on the negative stuff? Go ahead.
I don't see it up there, but how are settlements looked at on credit versus paid in full?
Yeah, so if you settle it for less than it's owed, I mean, I don't notice a large difference. I mean, it might be, there are some sources that think that maybe it might be slightly better to pay it in full than settle it. I've never noticed a difference, but I don't want to swear for sure there isn't. If there is, it's so minimal that I haven't noticed it. Let's put it that way. So, you know, you can pay it in full, but I don't think that there's enough of a benefit to warrant now if it's a small collection, it's, you know, $90, don't negotiate it, just pay it. But if we're talking about like $10,000, you know, obviously you can use that money better elsewhere. Hey, how are you?
I'm well, how are you?
Good.
What about student loans?
Yeah.
I have 2 children.
Yes. They're
They
expensive.
make pretty decent money, and I know they're gonna be buying soon, but they're out in LA.
Yeah.
But still, they do have student loans.
Yeah. So again, from different lenses. So from the lens of credit, student loans are not typically damaging to your credit because they're installment loans. So it's not like a maxed out credit card. I have heard that, so the nature of student loans is that when they're deferred, the interest keeps accruing, right? So if it says your original student loan was $10,000, but after you finish school now it's already up to $14,000 because it's been accruing interest the whole time. I have heard that if the balance is higher than the original limit, it can be a little bit damaging. I don't think it's substantial, but like a credit card too. Let's say you have a $1,000 credit card and you're over that limit. It's reporting at $1,100. That's definitely hurting your score. Getting it under the limit will help. So it's possible that might have a little bit of impact, but it's not huge. And installment debt does not hurt your score. In fact, it's probably helping their score because college students don't really typically have long credit histories. So student loans is their credit history. So as far as your credit score, it's probably helpful. Now, as far as qualifying for loans, that's another story. Different loan programs look at student loans differently. So for instance, FHA is one of the stricter ones. So no matter what your student loan payment is, if it's 0 because it's deferred, or if you have one of these income-based reduced payments because you just got out of college and you're not making a lot of money so you can't afford the full payment, FHA, regardless of what your payment is, for the most part, they need to use either the fully amortized payment to qualify you or 1% of the balance. And I'm seeing a lot of these kids come out with 6 figures of student loan debt. So if you have $100,000 of student loan debt, that 1% is $1,000. Even if your income-based repayment plan has a payment that's actually $150, we have to hit you with that $1,000 payment. So that program is the hardest. So if I see right off the bat that someone has a substantial amount of student loans, I'm not going to FHA first. That's not my go-to. Fannie Mae is the most lenient right now. And just so you know, these rules are constantly changing. So I'm telling you what the guidelines are today. If you had asked me 6 months ago, they might have been different. And if you ask me in 6 months, they might be different again. They're constantly in flux. But as of today, right now, Fannie Mae will use your income-based reduced payment. Okay, so if your payment, even if it's $100,000 of debt, but your payment's $150, we can use that. And that's how we're getting people into houses. That is my go-to program for people with student loan debt. And sometimes I've had people come to me and they had the fully amortized payment. And I told them, go get the income-based payment so I can qualify you, because that payment can't use. Deferred can never be used. It can never be qualified at zero. We have to qualify something. So the income-based payment is the best. Freddie Mac has a mix where instead of going 1%, they'll go up to 0.5%. So that's a little bit better. And sometimes Freddie has a couple other loopholes that are beneficial. So yeah, student loans is one of those things, like when someone calls me to buy a house, I'm constantly assessing different factors. Are they first-time home buyer? Can they qualify for down payment assistance? Could they get Community Reinvestment Act? But student loans is one of those filters right off the top of my head that I'm like, if I see student loans, I'm automatically shifting toward Fannie Mae in my head because that's going to be the most lenient. Fannie Mae is typically going to require a little better credit than FHA. So again, that may be something where they need to work on it until they get to the point, where they qualify. But, a lot of these kids coming out of college don't necessarily have bad credit yet. They just don't necessarily have enough. So I don't know. I know you came in late, but if you heard me talking about adding them as authorized user on your credit card, you will get their score up substantially.
I'm trying to get them to authorize me as a user on their
I'm with you. Let me know if you're successful on that. I want to know the trick to it. So yeah, student loans can definitely be a challenge. Okay, Zeke has arrived with the ever important sign-in sheet. So that is going to go around. Make sure you sign up for it. We will send out some follow-up information for you guys. So make sure your email is on there. Make sure it's legible, please. I know that is a really big challenge. We're used to typing nowadays. Nobody can write. But we will send out follow-up information if we can read your email address. Okay, was there another question over here? I thought I saw another hand. Yeah.
I was talking on the hospital bills. A lot of people
Oh,
have a lot of
yes. Thank you
hospital
for bringing that up. Yes. People have tons of hospital bills. Okay. Everything I said about collections, forget about that for hospital bills as far as mortgage qualifications.
Okay.
The mortgage companies do not care about medical collections. Okay? But that is not to say that those are not still affecting your score.
Correct.
Right? So they are still collections. They are still bringing your score down, but we're not going to hit you against them for qualifying for the mortgage.
Okay.
Yeah, those are the worst.
I never
Those
knew
are.
that, Marla.
Say it again?
I never knew that.
Yeah, no, because everybody's got them. They are the worst as far as billing, and a lot of people don't even know they have them, right? They sent it to the wrong address, they are, the medical collections are the worst, absolutely. All right, did I have another? Okay, so next steps. Any other questions on credit before I jump to next steps? Okay, so next steps are to get your personalized plan for credit repair, for home buying. You want to get that plan because I gave you a lot of information and you're more educated than probably 80% of Americans now about credit, but you still don't know everything and you may still have some ideas in your head that you did not hear from me that you're thinking, oh, I should go close my accounts. You're like, wait, no, Marla said not to do that. So getting a personalized plan that is customized to your situation, not just general knowledge, but customized that says, okay, for my situation, I need to do A, B, and C. Because it's not going to be the same. Some people need to pay down debt, some people don't. Some people just need to shift, again, from credit cards to unsecured loans. The answer is different for everyone depending on your situation. So once you have that, it helps you move forward. Because right now you probably have a little bit of information overload and you're like, it's great, but you get home and you're kind of like, oh wait, what do I do first, right? So that's where you don't need to figure that out. That's where I can tell you what you need to do first. And it'll be a bullet list. So it's not like some, elaborate thing that you have to figure out. It'll be a bullet list. It'll say, pay this, pay this, pay this, or shift this, open this, go do this, so you'll know exactly what you need to do for your specific situation and then follow up on that. So you can follow up back with me every month or two and say, okay, here's my progress. I got this. I saw in Credit Karma, my score jumped to this. So and again, because it's going to be from the lens of credit building, but also mortgage qualification and debt to income ratio. If you're working with a credit repair company, they only have one of those lenses. So they may help get your score up, or they may help handle your debt, but it may not be the best thing for your mortgage. I have one client I talked to earlier today. She worked with a debt consolidation company because she had a lot of credit cards. Well, it sounded like a good deal to her, right? She had this great monthly payment that was lower than her credit cards. All her credit cards got closed. Her credit card balances are extremely high. Her credit score tanked, right? So while it did help with her debt, I'm not saying they gave her bad advice, it was only through that one lens. They weren't also looking through the lens of the mortgage and, you know, the other factors. And so now she's calling me like, okay, what can I do now? You know, and now the options are worse. The options would have been better if she called me before she did that, you know, and now it's very limited. So getting that plan is the important step. And then again, not just getting the plan, not just getting the knowledge, but taking the action, doing what you need to do, you know, and whatever accountability, I don't know if you know someone else in the room, pick an accountability buddy, like put on your calendar once a month, we're going to check in, you know, keep each other on this path so we can reach this goal, because this isn't, again, just about building credit, okay? It's not just about building credit. It's not just about buying a house. It's about building wealth. It's about passing generational wealth. It's about owning. It's about building community. When you have the power of credit, there's so much more that you can do with that benefits your entire family and community, right? So this is a credit building class, but you have to remember that it's so much bigger than that, and focus on staying on track and passing that knowledge, talking to your friends and family who don't know, you know, and letting them know. Show them the Facebook Live. It's going to be recorded and available. Anyone can watch it. Anyone can call me, get their own customized plan. So definitely passing the knowledge along, and, you know, sending that information on to other people so everyone can continue to grow with that information. And then again, here at EXIT, they're always having training sessions. So this is one piece of it, but come to the other sessions. I don't know what topics they have planned, but it's all going to interrelate on getting you on that right path to owning real estate. And I don't want to jump topics, but if you guys hear me speak again, I don't know what the other topics are. I mean, I have some things that I'm passionate about. For instance, just a little sneak peek, I'm not going to get on my soapboxes, but buying multi-unit buildings is, you know, for me, like, hands down the best investment you can ever make, you know, because you can get those with low down payment. You live in a unit, the rent pays the mortgage, and then you move out, have rent coming from the unit you were living in, go buy another one, right? So there's a lot of ways to build wealth. That you can learn about all these other factors. Credit is step one, but then you can build on that. There's so much more you can do with that. Go ahead.
You're right about the multi-unit, because
Yeah.
I have one, but the thing about it is that if you want to be able to get some type of grant for that multi-unit, you have to actually live in that property.
Exactly.
And the city
And get the lower down
requires-
payment. Yeah.
Right, and the city requires that.
Exactly.
In order for me to even get maybe $10,000 or $15,000 to
Yep.
fix a roof or get a brand new boiler.
Yep. See, all these things have nuances. Yeah.
Right.
If you live in it, you get the best deal hands down, for sure. You get lower down payment, lower interest rates, grant money available. Yeah, for sure.
So will that, I didn't mean to cut you off.
Yeah.
I didn't to interject, but would that cause me problem if as far as my income would go down if I just stay in the unit? Let's say it's a three unit story, and then I live in there, that would shorten my income.
So the rent you collect from the other units actually qualifies as part of your income. So people think it's harder to qualify for a multi-unit building, and in most cases it's actually easier because that actual extra rent you're getting is part of your income. I've had people come to me and want to buy a single family house and can't do it. Your debt to income ratio is too high. But if you go buy a 3 or 4 unit building where you've got, you know, an extra $2,000, $3,000 of income coming in every month, you know, sometimes it's easier to qualify people. But yes, you're not getting the rent from the unit you're living in because you're living in it, correct. So compared to a strictly investment property where you get the rent from all of the units, yeah, it's a little bit less than that, but it's definitely more than a house. A house you get no rent at all, right?
So I benefit one of the ways, as far as the grant. If
Yeah,
I'm living in.
but so you're still benefiting from this. The value's going up. The tenants are paying your mortgage, which is making, you know, the loan go down. So you're building your equity. And then one thing I didn't mention too is your income tax breaks you get from owning real estate. So there's other ways too. And then in that case, from the cash flow, if you're getting rent, that's helping with the monthly payment. So it's either reducing the amount of money that you would otherwise pay if you were renting or owning a house, or once you move out, you actually get actual income from that. So there's multiple sources of income. And in most cases, your multifamily property is going to be higher. right? So say you're buying a $400,000 property instead of a $200,000 property. This is not a straight line. This is exponentially higher. So your growth is not just still $285,000. It's probably going to be like $500,000 because exponentially a higher price point increases it more, even if your personal monthly payment isn't higher because the tenants are paying that for you. So there's a lot of benefits to it. So you definitely can come learn about all these other topics. So I definitely recommend putting all of this on your calendar. You said it was the
fourth Wednesday of every month.
fourth Wednesday of every month. So definitely get as much education you can, and again, spread it within your family, friends. Question? Or are you just waving at me?
Hey, Marla. So my question is back to the multi-units.
Yeah.
How is the rent income assessed when the units are vacant? Let's say I
Yeah.
buy a 3-flat multi-unit. Do they pull the comps in the area for the rent amount for the bedroom?
Okay, I
size?
just want to say, like, come to the next workshop when we're going to talk about this, but I will answer it really quick. Really quick. The appraiser determines, so the same way that an appraiser would determine the value of the property by using comps, he
Correct.
determines the value of the rent by doing comps.
Got it.
And one more tiny layer, which this is a whole nother workshop we'll do too.
Okay.
But with renovation loans, if you're going to buy a property that needs fixing up, that rent is going to be based on what can you rent it for when it's fixed up, not current day condition. So your rent is even going to jump up higher with that. So yeah, so a lot more to learn. This is just the first step. So definitely keep coming back, learning more. I don't have paper cards, so take my information here or find it on the Facebook link.
Or reach out to your realtor.
Oh yes, reach out to your realtors. All your realtors, most of them know me, so.
Absolutely, and this is going to also be this entire presentation. If you want to watch it again, will be on YouTube. It's on our Facebook for our office. Some of our individual agents have shared it as well. And Marla brings up a great point. Next month, the fourth Wednesday of the month, next time it's going to be at our north side office. We're going to pop back and forth between the two offices. The fourth Wednesday of May. It is going to be on home buying, but we're focusing on what we're calling house hacking. And that is where you buy a multi-unit building, you live in one, and the rest of them are paying your rent. Because house hacking is where it's at right now. It's great if you like me, saved up and bought a condo. That's clap, clap, clap for you. We love it.
Yeah.
But turning around and actually buying a multi-unit building where you're potentially living there rent-free or even with a cash flow, or maybe eventually moving on and buying multiple multi-units over the years. That's how you really build generational wealth. So thank you guys again very much for coming. Marla, thank you very much. This is awesome. So we will see you guys next month. Feel free to stay around, grab some more wine and sandwiches while you're here. We'll be here for a little bit.
Yeah.